Hey guys, this is Ben Leibovich coming at you once more. Pleasure to be speaking to you. Thank you for taking the time to listen to this. This video was spurred on by an article that I read on Bigger Pockets. I actually commented a couple of times in that article. I'm going to be talking today about financial literacy, not so much real estate, although the tangent, the extension of what I'll be talking about is real estate, but the basic concept here is financial literacy, specifically frugality, specifically how we can, let me rephrase that, whether or not the first step to financial freedom, independence, success should be frugality and control of expenses. The basic premise is that yes, I don't think there's too many people that would disagree with me in saying that yes, it doesn't matter how much you make. If you spend everything, then you got nothing left. Or if you spend more than what you make, you've got you're even worse off. Here's the concept I need to introduce you to. Some of you may know it, but we refer to it as burn rate. So here's the net income coming into the household. How much of that net income are you spending to cover your costs? For instance, if you're bringing in $10,000 a month and you are spending $5,000 a month, then your burn rate is that $5,000 a month. Represented as a percentage, it's a 50% ratio. You can call it 50% expense ratio, 50% burn ratio. So then the next question I have for you is this. What do you think a safe burn ratio should be? What do you think a sustainable burn ratio should be? Forget the top line for now. Here's what you make. How much of that can you safely spend and for it to be sustainable? Well, I don't know. For me, I think you're okay between 45 and 55%, and you are great between 30 and 35%. In other words, if you are bringing in $10,000 a month, but you manage to live on $3,000 a month, then your burn rate is 30%. Burn rate of $3,000 constitutes 30% of $10,000. Okay, let's bring this into reality. Or let's take one more step. Obviously, the burn rate formula has two parts. You've got the top and you've got the bottom. Saving and frugality, I should say, not saving. Frugality is a function of pressing down on your bottom line. Okay? The reality is that there's only so much that you can squeeze it. You have a family of 3, or a family of 4, or a family of 5. They have mortgage/rent. They have health insurance. They have auto insurance. They got to put gas in the car. They probably have car payments. They got to put bread on the table. They got to buy clothes. They got to buy toiletries. There are certain limits that are reasonable that you are not going to compress any more than what is possible. So, what is that? Can a family of 4 live on $3,000 a month? Can a family of 4 live on $4,000 a month? Can a family of 5? You have to decide that in your mind. Look at your budget, look at what you are spending, and decide, can it be compressed anymore? That's the first step. The second step, though, is if you are like me and you believe that a burn ratio of 100% is not safe, then that means that you need to be generating net income to you, meaning gross income minus taxes, take home pay, okay, that's higher by a certain percentage than your burn ratio. So for instance, if your burn ratio is $3,000 a month, and you believe that in order to be safe and in order for it to be sustainable, your burn ratio as a percentage of your net take-home pay cannot exceed 50%, you have to generate $6,000 of revenue. Okay? If you believe like me that you should be making, you should be living on 35%, of what you are generating, then in order to spend $3,000, you better be making about $9,000 or whatever it is. Okay? There's some realities, some distinctions that I want to cover under this umbrella. One is that there's only so much that you can cut. There's only so much that you can compress. Certain things in life are fixed expenses. They just are what they are. You got to have a car. For most people, that means having a car payment. Yeah, you can splurge and you can pay $1,000 a month, or you can pay $227 a month. But at some point, unless you have the cash with which to buy the car, you're going to have that payment of some sort, and you're not going to be able to compress it much lower than reasonable. Okay? The same goes for food. The same goes for clothing to a certain extent. The same goes for gasoline in the car. The same goes for health insurance. Yeah, there's fluctuations, employers, how much employers cover, some people are health savings, I understand all that. But there has to be something, some level where you say, you know what, this is just, it is what it is. Well, what that means is that you have to expand the top line, okay? Here's the next extension and distinction. And that is that what's the biggest expense that we have against our income? Here's your gross income. Taxes. What it takes to get from gross income to take home pay is taxes. And the big distinction here is that W-2 income is not only very difficult to grow in magnitude. Yeah, you can get a raise. But let's be honest. You are not going to go, if you're making $50,000 right now, you are not going to go to 85 overnight. Okay? W-2 income is very difficult to grow the top line, and there are virtually no legal ways to shelter any of that income, so that by the time you get to taxable income at the bottom of the first page of your tax return, that it looks lower legally. And the distinction is that in the world of business, entrepreneurship, and real estate, as part of that, there are many, many, many ways in which we can take gross income and we can show it and allocate it in ways that controls to a very large extent our exposure as it relates to taxation. Okay? So when we're having this conversation about frugality, yes, on the one hand, I think that if you're making $50,000 a year, you shouldn't be driving a fly-looking car that's costing you $700 a month. That's not reasonable. If your income is W-2 income and you are getting paid $70,000 and you're bringing home 75% of that because your effective tax rate is 25%, you should not be spending $700 a month to drive that fly car. Agreed. But on the backside of it, that's peanuts compared to the reality that you simply cannot do anything about that 25% effective tax rate. That's the big bite. That's the big problem. As much as a car is maybe not appropriate and is a problem, the big problem is that you cannot control the biggest expense against your income that you have, as long as your income is W-2 variety. Now, I'm not going to pass judgment in this video. I'm not going to tell you do this versus that. This is intended to get you to think. Hopefully I have. My name is Ben Leibovich of JustAskBenWhy.com. Thank you so much for watching. Have a great day.